In last Friday's Stock Talk, R asked me the question, what if we have another subprime crisis and we see the bottom fall out of the market as a result of bad banking? And I think what he was referring to was the commercial real estate crisis that's looming in front of us because many office buildings are empty. This has been brought to my attention as our tallest building here in Birmingham, the Shippett Tower, 34-story building, has gone into receivership. And with a little bit of research, I found that here in Birmingham, there are 162 loans that are maturing worth $633 million by the end of this year that could fall into the same category that many commercial loans are in around the country. So I did some research and I wrote an article about it. In fact, the article's posted on our website, Best of Us Investors. And I think it's a damn good article. But I'm dyslexic, so I can't read it to you. So what I'm going to do is I'm going to ask my avatar to basically read it to you and tell you what we believe is in the future. Not that I think it's anything that's looming right now, not what's causing the market to correct right now. I called it crash a week ago and was told cars crash, markets correct. So, and we'll get to that. But I want my avatar to share with you this article I wrote. It's on the website, and then we'll talk a little bit more about it.
The commercial real estate market is on the verge of a significant downturn, potentially mirroring the 2008 financial crisis. Recent trends suggest that fraudulent activities, reminiscent of the liar loans of the last recession, are now plaguing commercial real estate. I will delve into how these issues are impacting the banking system and what it means for the broader economy. During the boom of 2021 to 2022, many investors overstated their property's cash flow to secure loans. This phenomenon, similar to the stated income loans of the 2008 residential mortgage crisis, saw investors inflating income figures to obtain larger loans. Banks, driven by the fear of missing out and a competitive lending environment, often failed to verify these figures, resulting in loans based on falsified income data. When reality hits and the actual cash flow of these properties falls short of the inflated figures, investors will struggle to meet their mortgage payments. This discrepancy leads to defaults, putting banks at risk. As these fraudulent loans come to light, banks are forced to recognize significant losses, which impacts their balance sheets and reduces their capacity to lend. The consequences of this fraud extend beyond individual banks. As banks tighten their lending criteria to mitigate risk, it becomes harder for investors to secure financing for new projects. This reduction in lending can lead to a slowdown in the real estate market and the broader economy. Layoffs in related industries further decrease aggregate demand, potentially leading to higher unemployment rates and a negative economic feedback loop. The commercial real estate transaction process is heavily influenced by commission-based incentives. Brokers, loan originators, and even buyers are motivated to close deals at the highest possible values, often at the expense of thorough due diligence. This system creates a fertile ground for fraud and misrepresentation, as each party prioritizes their financial gain over accuracy and transparency. Debt service coverage ratios, DSCR, are critical in determining the amount a lender can safely loan against a property. As lenders revisit these ratios, they are discovering that many properties do not meet the necessary thresholds, exposing the fraudulent income claims made during the boom period. This revelation forces banks to reassess their loan portfolios and recognize the true extent of their exposure to bad loans. The issues in commercial real estate are not isolated. Banks' funding costs are rising, and many are struggling with assets that are no longer yielding sufficient returns to cover their liabilities. This scenario is reminiscent of the problems faced by Silicon Valley Bank, where the need to sell treasuries to meet withdrawal demands resulted in significant losses. The interconnected nature of the banking system means that problems in one area can quickly spread to others. As banks face liquidity issues and increased counterparty risk, they become less willing to lend to each other, exacerbating the overall problem. This interconnectedness makes it difficult to isolate and contain financial instability, leading to a broader systemic crisis. Understanding the current dynamics in commercial real estate and banking is crucial for both investors and businesses. The patterns of fraud and systemic risk indicate that we are potentially in the middle innings of a broader economic downturn. However, for those prepared to navigate these turbulent waters, there are significant opportunities to be found. By staying informed and proactive, investors can position themselves to not only weather the storm, but also capitalize on the emerging opportunities in the commercial real estate market.
Okay, so what do we learn from that? Well, I think what we learned is when we ever have a bad crash like the Depression or the subprime crisis, it's the fault of the banks. It's the fraudulent behavior. It's the greed. It's just everything wrong with our banking system is what turns everything upside down. And to give you some representation of that, the S&P 500, I looked it up. It was Lehman Brothers filed for bankruptcy on September the 15th, 2008. And the S&P 500 dropped 57%. And it took the S&P 500 down from 1,557, and it didn't reach that level again until March of 2013. So that's somewhere in the neighborhood of what? 6.5 years. Now, I looked at it and said, but was it really that bad for everything? And if you look at a chart on Google, on Amazon, and on Apple, you'll see that it actually went from September of '08 till about October of '09. It was about a 1-year drop for the tech companies, but the overall market, it took them almost 7 years to recover. So what can we learn from that? Well, I think we need to recognize we have a very positive movement in the area of AI and semiconductors and what I choose to call the democratization of compute. And these are positive things, but can we totally ignore a banking failure? Let's face it, they're crooks. They've done it now twice, and we know from what you just heard my avatar explain to you, they've done it a third time, and it's coming to fruition. As I said, here in Birmingham, the banks indicated that they had 162 loans worth $633 million that are maturing between now and the end of the year. That will probably take our regional banks into some very, very rough waters. How that will spill over into the overall market, I think it's fair to say it's going to be a negative impact. Is that what's causing the downturn in the market today? No, I think it was a big disappointment in Tesla. Some not so positive things from Google, and we'll probably see more of that. I see this as between now and the end of the year as a buying opportunity. I'm trying to free up some cash and some dividend stocks that I have that I've collected the dividends on, and I want to raise that cash to buy more into stocks like Amazon and Google as they hit their buy opportunities. Now, what is the buy opportunity? That's what I keep on my cheat sheet. I went through my whole cheat sheet just today and looked on the charts and said, okay, with the pullback that Google just had, with the pullback that Tesla just has, where is my opportune buy-in price? And that you'll find on my cheat sheet. So putting all this into perspective, the banking crisis is coming. It will have an effect. It will not hurt, I don't believe, my tech sector, because you cannot stop this train, this AI train, this democratization of compute, me having the ability to identify the 66 million of you who manage your own portfolio and then create a website built around you and my work and my team's work to answer your questions, to make that website speak to your specific and individual needs. That's the democratization of compute. A banking crisis won't stop that. It might slow it down. It might make it a little bit a rough ride for a while, but that is in our 2.5-year perspective. My objective, my single goal is to buy the stocks that I want to own relative to this democratization of of compute and of my data, putting my data in my hands so I control the communication with my TAM, my total addressable market. As I said, 66 million of you. That is my objective, to buy the stocks that are going to put me in a position to do that and to build my business to replicate that, in my case, of Amazon. I want my website to do everything that Amazon can make its website do. And if I can do that, I can become a billionaire. Jeff Bezos has proven it to me. Mark Zuckerberg has proven it to me. Bill Gates has proven it to me. If I can control my TAM, my total addressable market, and deliver to them what they want at a fair price, I can become a billionaire. I just have to have the ability to speak directly to them and identify their needs and their desires and fulfill them. I can do that if I can put an AI factory right there and access the data I need to deliver my product. The banking crisis will get in my way. It'll make the road a little bumpy. But you aren't going to stop this train. And if you'd like to ride on this train, or no, it's a bus. If you'd like to get on this bus, you just come to the website. I'm going to give you a 14-day free trial. If you don't like it, tell me to go to hell, and I'll be okay with that. Because there's 66 million of you. That's enough for me. Talk to you more about this in the coming days.